Hello everyone, welcome to Tesla Daily News. Today is July 3rd, Thursday, and the following is the latest Tesla news. According to recent market data, Tesla's stock closed at $393.45, down sharply from the previous close of $425.30, after opening at $428.01 and touching an intraday high of $432.35 and a low of $389.30, on very heavy volume of about 73.7 million shares. In simple technical terms, sharp bearish reversal on elevated volume, potential short-term downside risk. For investors, this kind of wide trading range combined with a close near the day's low often signals profit-taking, nervousness about near-term fundamentals, or positioning ahead of key news such as quarterly deliveries and earnings. Traders will be watching whether the stock can stabilize above the recent low or whether momentum sellers continue to pressure the price toward previous support zones. According to NDTV Profit, BYD is set to reclaim the title of the world's top seller of fully electric cars from Tesla in the latest quarter, with BYD reporting deliveries of around 557,000 battery electric vehicles for the 3 months through June. Analyst estimates compiled by Bloomberg suggest Tesla's quarterly unit sales will be closer to about 396,500 vehicles, implying that BYD will again outpace Tesla on pure EV volumes. For Tesla investors, this matters less for immediate profit per car and more for the long-term narrative. The company is no longer the uncontested global volume leader in battery electric vehicles. In previous years, Tesla's valuation premium was partly justified by its dominant volume position in technology leadership. Now, Chinese competitors, especially BYD, are proving they can scale fast, compete on price, and innovate in batteries and chips. Still, Tesla remains much stronger on margins, software revenue potential, and high-income market penetration, particularly in North America and Europe. The rivalry with BYD frames the broader EV landscape as a two-horse race at the global level, with regional challengers like Geely, Xiaomi and others adding pressure in China. From a stock perspective, any perception that Tesla is sustainably ceding volume leadership could weigh on multiples unless the company convincingly pivots the story towards software, autonomy, and energy. According to the Electric Vehicle Council data reported by the Canberra Times, Tesla has just delivered a record-setting month in Australia, reinforcing the bullish part of the global picture. The American EV maker sold about 8,670 vehicles in June, its biggest month ever in that market, beating the previous record month of May by roughly a quarter. Leading the charge was the Model Y SUV, with around 8,072 units sold, a figure so high that it is likely to make the Model Y the single best-selling vehicle in the country for the month, across all brands and powertrains. The Model 3 sedan contributed roughly 600 units. Over the first 6 months of the year, Tesla has sold about 23,588 vehicles in Australia, a surge of around 66% compared with the same period a year earlier. Part of this boom is attributed to high fuel prices linked to geopolitical tensions and to favorable tax policy, specifically the federal fringe benefits tax exemption for many electric vehicles, which allows buyers to effectively pay for the car from pre-tax income. For investors, this Australian story illustrates how Tesla can dominate when policy and infrastructure align in its favor, and how much latent demand exists when total cost of ownership tilts toward EVs. It also demonstrates that even as competition intensifies globally, Tesla can still capture leading market share and post exponential growth in specific regions, supporting the case for a diversified global revenue base. According to Cash.ch and Reuters, Tesla registered a strong rebound in new car registrations across several European markets in June. In France, Tesla registrations more than doubled, rising by about 105% compared with the prior year period. Sweden saw growth of roughly 56%, Italy and Portugal each recorded gains of about 43%, and Denmark posted an increase of around 39%. Spain also grew, although more modestly at approximately 5.5%. Norway was a notable outlier, with Tesla registrations falling by roughly 43%, partly due to buyers pulling purchases forward earlier because of anticipated cuts to tax advantages, leading to a temporary cooling. Overall, analysts expect Tesla's worldwide second quarter deliveries to show around a 5% increase, suggesting that Europe is contributing positively to that recovery. For shareholders, this European upswing matters because Tesla had been losing market share on the continent to Chinese brands and to a flood of new EV models from legacy automakers. It also shows that incentives, corporate fleet electrification, and product availability can quickly change Tesla's trajectory in individual countries. If France's experience is any guide where state subsidies and rapid fleet electrification push Tesla's numbers higher, policy risk remains double-edged. Supportive regimes can unlock demand, while adverse rules, tariffs, or subsidy cuts can do the opposite. According to Car News China, Tesla is experiencing a sharp recovery in China registrations following a difficult start to the year, even as safety questions remain in the public eye. The report describes a serious accident involving a Model Y that hydroplaned on the G50 Shanghai-Chongqing Expressway during heavy rain, struck a guardrail, and immediately caught fire. A passing Li Auto i6 driver stopped, managed to extract the incapacitated Tesla driver, and left the scene just before flames fully engulfed the cabin. Engineers will study the incident as another data point in understanding battery pack integrity and thermal propagation under high-speed collision conditions. Beyond the dramatic rescue, the article notes that Tesla delivered 47,281 vehicles in China in May 2026, according to China EV Data Tracker, representing an 82% month-on-month rebound from a low point of 18,485 units in January. Despite that recovery, Tesla's market share in China stands at about 3.1%, with deliveries still volatile. April saw a steep retail contraction of more than 50% to around 25,956 units. In response, Tesla is ramping up recruitment for smart driving and driver assistance roles across 9 Chinese cities, clearly trying to accelerate localization and validation of its autonomous driving capabilities. For investors, this highlights 2 key themes. First, China remains intensely competitive, with policymakers, courts, and insurance frameworks increasingly focused on liability and safety standards in complex highway crashes, potentially raising costs for all players. Second, Tesla's ability to localize its technology stack and deliver compelling smart driving experiences may be crucial to maintaining relevance against domestic brands that are innovating rapidly on software and user experience. According to Heise Online, Tesla has begun testing a steering wheel-free, pedal-less Cybercab Robotaxi prototype on public roads in Austin, Texas. The 2-seat electric vehicle is designed to operate using Tesla's Autopilot and full self-driving system in a fully autonomous mode, without traditional driver controls such as a steering wheel or brake pedal. For the current tests, a safety operator is sitting in what would normally be the passenger seat, monitoring the system's performance. These trials come as the U.S. National Highway Traffic Safety Administration has proposed regulatory changes that would remove the long-standing requirement for a physical brake pedal in vehicles designed to operate exclusively in autonomous mode. If this regulatory shift is finalized, it could eliminate a significant hurdle for Tesla's robotaxi ambitions, opening the door to commercial deployments of vehicles that are fundamentally different from traditional cars. From an investment perspective, this development is central to the long-term Tesla thesis that much of the company's value lies not in selling hardware but in monetizing autonomous driving software and mobility services. A scalable robotaxi network could, in theory, compress cost per mile for transportation, generate high-margin recurring revenue per vehicle, and justify software-like valuation multiples. However, numerous obstacles remain: regulatory approval in each jurisdiction, demonstrated safety performance across varied conditions, public acceptance of vehicles without conventional controls, and intense competition from other autonomous players using different technology stacks. Investors should see the Austin Cybercab tests not as an immediate revenue story, but as a high-risk, high-reward option on Tesla's future. According to the Frankfurter Rundschau, Tesla is facing an ongoing safety and compliance challenge much closer to home at its Gigafactory in Grünheide, Germany. The head of Tesla's internal company car program told employees at a recent works meeting that he receives more than 100 traffic tickets per month linked to staff driving company vehicles, and he urged workers to obey traffic laws, respect speed limits, use mirrors when reversing, and avoid damaging curbs. The issue is not new. As far back as October 2025, the Works Council had warned about employees driving at 70 to 80 km per hour on the plant's south parking lot, where the limit is 30. The Health and Safety Committee called the situation a heightened accident risk and announced physical countermeasures like narrow lanes and additional crosswalks. Yet less than a year later, the topic has resurfaced, suggesting limited effectiveness so far. The irony is obvious: a company developing advanced driver assistance and autopilot capabilities is struggling to get its own staff to drive cautiously on its premises. Strategically, this may seem minor next to global sales and autonomy, but for investors it touches on corporate culture, compliance, and reputational risk, especially in a country where Tesla's factory is already under scrutiny from labor groups, environmental activists, and regulators. Poor safety discipline on site could eventually translate into higher insurance costs, potential legal exposure, and strained relations with local authorities. According to Golem, a Tesla semi-electric truck has been involved in a fatal rear-end collision in Nevada, raising questions about driver fatigue and heavy vehicle safety. The report states that the semi's driver apparently fell asleep and plowed into stationary vehicles, causing a deadly multi-vehicle accident that left 2 people dead. While the article does not specify the exact assistance systems in use at the time, it underscores that human vigilance remains critical, even in advanced electric trucks featuring driver assistance technologies. For Tesla, the Semi program is part of its broader push into commercial transportation, where long-haul trucking offers significant potential fuel savings and emissions reduction compared to diesel. However, commercial fleets and regulators are particularly sensitive to safety performance and uptime. High-profile accidents involving innovative vehicles can slow adoption, prompt regulatory reviews, or require costly software and hardware updates. From an investor's angle, the Semi is still a relatively small part of Tesla's overall story, but incidents like this highlight that scaling into freight will require not only technical sophistication but also robust training, fatigue management, and clear operational protocols for drivers. According to Liberty Times Auto in Taiwan, Tesla is dealing with a service and supply chain issue that directly affects customer satisfaction and perceived reliability. A batch of 2023 Model Y vehicles in Taiwan has reportedly experienced high-voltage big battery failures, and some owners are being told they must wait up to about 1 month for a replacement pack due to a lack of spare inventory. The problem appears to affect certain older 2023 Model Y variants, which use different battery chemistries depending on trim, rear-wheel drive versions equipped with CATL's LFP lithium iron phosphate packs, and long-range or performance versions using ternary lithium batteries. All of these packs are covered by an 8-year or 192,000 kilometer warranty, but owners whose cars are immobilized may receive no loaner vehicles during the wait. Tesla's guidance to owners remains the usual best practices. Daily charging to around 100% is acceptable for LFP packs, while ternary packs should generally be charged only up to about 90%. Reserving full charges for long trips, and long-term storage should keep state of charge near 50%, ideally while plugged in. For investors, the key points here are not the exact chemistry details, but rather the service experience and the robustness of Tesla's after-sales logistics. Long wait times for critical components like traction batteries can damage brand perception, especially in markets where traditional automakers have deep dealer networks and established service capacity. This episode also illustrates how global demand growth can strain parts supply, potentially constraining Tesla's ability to keep up with both new sales and maintenance needs in fast-growing regions like Taiwan. According to ABC 13 in Houston, Tesla's Autopilot and so-called self-driving capabilities are again in the legal spotlight after a fatal crash in the Katy area of Harris County, Texas. Authorities report that a driver, Michael Butler, has been charged with manslaughter after he allegedly drove a Tesla into a home at high speed, killing a 76-year-old woman inside the house. Butler reportedly told deputies that the car was in self-driving mode at the time, but Tesla's data indicates he overrode the feature before the crash. The sheriff's office states that the vehicle failed to maintain its lane, left the roadway, and slammed into the house. For Tesla investors, these incidents matter in several ways. First, they influence public perception of autopilot and full self-driving, potentially affecting demand and regulatory attitudes. Second, they may contribute to legal and financial risks, from individual civil suits to broader regulatory investigations that could impose design changes or operational limits. Third, they highlight the persistent confusion around what Tesla's driver assistance systems can and cannot do, particularly when branding uses terms like autopilot or full self-driving for systems that still require active human supervision. As Tesla pushes toward more ambitious autonomy with programs like the Cybercab, managing these safety and communication risks will be crucial to maintaining trust from regulators, customers, and investors. According to multiple regional reports consolidated across Europe, the broader context for Tesla's recent performance is that global EV demand is still growing, but at a slower pace in key markets, with fierce price wars especially in China. This environment has pressured Tesla's margins and forced price cuts in several regions over the past year, contributing to the volatile stock price. Analysts now expect Tesla's second quarter deliveries to rise modestly, roughly in line with the mid-single-digit increase suggested by June European data, which may ease some immediate fears about a demand collapse. Nevertheless, the competitive landscape is clearly more challenging, with strong Chinese brands, improving legacy automakers, and regulatory uncertainty on tariffs and subsidies. Investors will be watching upcoming delivery and earnings reports to see whether Tesla can offset lower average selling prices with higher volumes, software revenue, and cost reductions, including internal AI and inference optimizations that reduce operational expenses. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for the next update.